Welcome to Argent's 2024 January and February Market View. This is Matt Rasusha, the Chief Investment Officer and Principal at Argent. At Argent, our differentiation is our deep knowledge and practice of tax, estate planning, and investments under one roof. You can connect with us on LinkedIn, Instagram, Facebook, Twitter, X, and YouTube. So the conclusion, what's going on? The bull market that started in October 2022 is likely to continue. We've been bullish for over a year now. Near term, inflation may stay stickier than investors expect. That's new, in our opinion. If that is the case, investors' expectations for the Federal Reserve to cut rates in March look optimistic. And so until investors recalibrate their inflation and rate cut expectations, stock and bond markets may remain choppy. They've been choppy to start the year. One thing we look at is breadth. Breadth is how many stocks within a universe are advancing and how strongly are they advancing. Well, Ned Davis Research, they run regressions on breadth statistics to see if there are common historical patterns that may repeat or give us an indication of what the market is telling us, as the stock market is a forward indicator and is always trying to price in the future. One with really strong statistical significance is that when the percentage of stocks above their 50-day moving averages in the S&P 500 exceeds 90%, which just happened on December 26th, the S&P has been positive a year later, 100% of the time in all cases, by an average of 18.47%. The last time this was triggered was in May of 2020, and there was a very strong bull market after that. More fundamentally, looking at the economy, despite higher interest rates, the availability of credit to consumers and businesses is favorable. So credit is available to expand your business or buy a home. And the credit conditions index is comprised of spread, delinquency, debt service, debt capacity, and lending standards indices. So it really tells us, if you're a consumer that has a strong balance sheet with decent credit, can you get a loan to expand your business? Can you get a loan to buy a home? Absolutely, you can. Very difficult to see a recession when credit is available. And one of the reasons it may be available is that the financial obligations ratio, which is debt, vehicle leases, rent, insurance, and property taxes, it's below the historical average. It's income. What percent of income goes to financial obligations? And consumption is about 70% of GDP in the US, so the consumer is in good shape. And look at job openings. Employers are still in the market for new hires. There remain 1.4 times the number of job openings per unemployed in the US. So there are plenty of jobs for those that want them still. Again, a recession seems unlikely given that fact. And inflation is on a downward trajectory. However, with the previous economic statistics, credit conditions, consumer strength, labor market strength, it could stay stickier than expected. And I'd be remiss if I didn't mention that the inflation trajectory could also be altered by some of the geopolitical tensions in the Middle East, affecting shipping routes and oil production, although any impact thus far has been muted, and our base case is that it stays that way. So if inflation does remain stickier than investors expect, the Fed may keep rates in the 5.25 to 5.5% range longer than is currently priced in. But with a recession unlikely, the stickier for longer scenario may continue to cause volatility as investors recalibrate their expectations, but it's unlikely to derail a bull market because a recession is unlikely. And then it begs the question, are investors kind of in a win-win situation, right? If by chance the economy cools faster than expected, it means inflation is likely to cool faster than expected, as well as aggregate demand from consumers drops more quickly than expected, driving inflation down. And so the Fed may even move faster than what is currently priced in, and that would actually support both stocks and bond markets. So again, if growth is stronger than expected, if inflation stays stickier, so the Fed stays where they are longer, but recession is unlikely, and then eventually if the economy starts to cool faster than expected, the Fed will react. Now there may be some frictional volatility between when the market's telling the Fed, hey, the economy is cooling faster than you think, and the Fed actually does something. But again, that's just a correction. That's not a bear market per se. And we've seen some of that volatility play out this year since 1/1. Markets are kind of been volatile, more negative than positive. And again, that may continue until we start to see a recalibration of expectations. Yields have also increased because investors are starting to price in the Fed keeps rates higher for longer than they expected when the year began. And you can see sentiment at the beginning of this year, at the end of 2023, was in its extreme optimism zone. Investors were really optimistic. I think in this, the data in this chart points out that typically you're going to see better returns when there's more pessimism than optimism. So volatility, a recalibration in Fed expectations, and a correction in sentiment to extreme pessimism would likely be a precursor to the next up leg in this bull market. And that next up leg would probably get us to all-time highs again. But again, I think you need sentiment to blow off. You need people to recalibrate their Fed expectation. That probably happens in tandem. And then you get the next up leg. When that is exactly, who knows? If you're following kind of the presidential cycle and the Dow Jones Industrial Average, what is the average daily return of each year of the presidential cycle, of each day, of each part of the year? That's what this chart shows. And the first half of presidential years tend to be choppier than the second half. So, so far the market's adhering to this traditional pattern. So again, just be prepared for some chop, but we're in a bull market, and I would say don't try to trade around it. Stay invested, potentially overweight stocks within your risk tolerance levels that you have, within your plan. And I would also recommend that you stay at about equal weight duration to your benchmark, equal weight interest rate risk. I don't think yields have much more to rise, if any. The yield curve will continue to steepen, so you can position for that as well within your bond portfolio and take advantage of that. So if we are in fact in a bull market, what could it look like? The mean for all bull markets is 86% gain over 576 days. The Dow is up less than 30% over 325 market days. But cyclical bulls within secular bulls, which is what it looks like we are in today, we're in a bull market within a longer term bull market that started in 2009. That's the secular bull. Still not over. It's still going. Typically, you get about 105% over 751 days. And we're, again, about 325 days in, so maybe about halfway into it. And the returns are only about a third away to the average. So some room to go if you're believing this is continuing to be a bull market. You can check out our investment strategies. We're very customized, but we also run specific strategies for investors within that framework: value, hedge fund, asset allocation, dividend, innovation and growth, and private equity and private real estate. We also run bond strategies now as well. More info on that coming. Again, Matt Rastuccia, the Chief Investment Officer and Principal at Argent. Thank you for listening.